Have you ever had that feeling that you're being told one story while the people with the most skin in the game are quietly doing the exact opposite? Well, right now, the mainstream story is pretty clear. Oil is old news. It's a dying industry on its way out. But if you look closely, you'll see some of the savviest investors on the planet. We're talking billionaires moving enormous amounts of money into energy. It makes you stop and ask, what do they know that the rest of us don't?
Welcome to the Bullion Signal Podcast, the channel where we tune out the noise and focus on the signals that truly matter for protecting and growing your wealth in these uncertain times. And today, we're decoding a massive signal. You see, when someone like Warren Buffett, a man who famously avoids industries he doesn't understand, takes huge positions in companies like Chevron, you have to pay attention. When Ray Dalio, who built one of the world's largest hedge funds by obsessively studying historical cycles, starts warning about the end of a debt cycle, you listen. These guys aren't rolling the dice. They're masters at recognizing patterns. And the pattern they're seeing right now is one that has shaped the rise and fall of empires for centuries. If you're looking for an edge in understanding our economy, make sure you subscribe to Bullion Signal. You won't want to miss what's coming. So, what is this pattern? What's the secret they see? That's what this whole explainer is about. And the fascinating thing is, it's not some complex algorithm or a secret government report. No, it's a pattern that's written in plain sight, right in the pages of history. It's a recurring cycle that shows how every monetary system is born, how it lives, and, inevitably, how it dies. And once you understand this pattern, you'll understand exactly why real, productive things, like oil, become the final safe harbor when the financial system itself is no longer safe.
At the heart of their thinking is a surprisingly simple but incredibly powerful idea. The claim is that every single fiat currency system throughout all of human history follows a predictable four-stage life cycle. Now, this isn't about politics, it's not about left or right, it's really about math and human nature. And once I lay this framework out for you, you're going to start seeing it everywhere, from ancient Rome all the way to modern-day America.
Okay, so here are the four stages. Stage one always starts with stability. The money is backed by something real, a tangible asset like gold or silver. This puts a limit on how much can be created, which builds trust and discipline. But then comes stage two, expansion. A government faces some kind of pressure, maybe a war, a recession, or just promises it can't afford, and it starts creating more currency than its tangible backing can support. At first, this feels great, like a boom, but it's the beginning of the end. That leads to stage three, the crisis of confidence. People, markets, and other nations start to realize the currency is being systematically devalued. The math just doesn't work anymore as debt spirals out of control. And that leads, inevitably, to stage four, the currency reset. The currency either collapses into worthlessness through hyperinflation, or it's officially devalued and replaced, triggering a massive, often brutal, transfer of wealth. Now, you might be thinking, okay, that's a neat theory, but does it actually happen in the real world? Absolutely. This isn't just an abstract idea. This pattern is a historical fact. It has happened over and over again, and the consequences for people who didn't see it coming have always been catastrophic. To really get a handle on what this means for us today, let's look at two huge examples from the last century. Our first stop is one of the most famous and terrifying monetary collapses of all time, the hyperinflation in Germany's Weimar Republic back in the early 1920s. This is the ultimate cautionary tale of just how fast a modern, sophisticated industrial society can be completely brought to its knees when its money stops working. What's just so staggering when you look at this timeline is the speed, the sheer terrifying speed of the collapse. In 1914, Germany was on a gold standard. That's your stage one stability. But then they had to finance World War I, so they cut the cord to gold and just started printing money. After the war, facing impossible reparation payments, the printing went into overdrive. That's stage two. By 1922, the currency was already in deep, deep trouble. But then, in 1923, Stage 3 hit like a tidal wave. The government started printing money to pay striking workers, and the currency went into absolute freefall. It got so bad that by November, a single US dollar was worth 4.2 trillion German marks. Stage 4, the reset, was a total wipeout of the old currency and everyone who held it.
So here's the most important lesson from that whole disaster. It wasn't just a financial event. It ripped the fabric of society apart. It created a massive forced transfer of wealth. Anyone, and I mean anyone who had their life savings in paper assets like cash in the bank, government bonds, or pensions, they saw it all turn to worthless paper. Their entire life's work just erased. But the story was very different for those who held tangible, real-world assets. Things like farmland, apartment buildings, factories, physical commodities. Their wealth was preserved. This is the critical lesson that repeats itself in every single one of these cycles.
All right, I know what you might be thinking. That was Weimar Germany, a unique post-war crisis 100 years ago. It could never happen here. Well, let's look a little closer to home, because the very same pattern, though not as explosive, played out with the US dollar itself, and it led to a world-changing event that created the very financial system we live in today.
This slide perfectly illustrates that shift. After World War II, the world operated on something called the Bretton Woods system. The US dollar was pegged to gold at a fixed price, and every other major currency was pegged to the dollar. This was classic Stage 1 stability. But then came the 1960s. The costs of the Vietnam War and massive new social programs led the US government to print far, far more dollars than it had gold in the vaults to back them up. That was Stage 2. Pretty soon, other countries, like France, got nervous and started showing up asking for gold in exchange for their dollars. To stop the U.S. from being drained of all its gold, President Nixon in 1971 went on TV and formally severed the dollar's link to gold. That was a Stage 3 crisis. The dollar was now backed by nothing. To save it, the U.S. government engineered a brilliant move, the petrodollar system. They made a deal with Saudi Arabia to price and sell all their oil only in U.S. dollars. This forced every country in the world to constantly buy and hold dollars, not to get gold, but to buy the energy they desperately needed. In effect, the dollar went from being backed by gold to being backed by oil. Okay, so we've looked at the history, we've seen the pattern, and this brings us to the single most important question of our time. If we accept this four-stage pattern, where are we today? Well, the source material we're analyzing makes a very strong case that we are deep, deep into Stage 3, the crisis of confidence, and the warning signs are flashing red all around us. The number one symptom of Stage 3 is always an impossibly large mountain of debt. It's the inevitable result of decades of Stage 2 currency printing. Right now, the global financial system is choking on over $318 trillion in debt. I mean, that number is so big it's almost meaningless. But it's not just a number on a screen. Every single dollar of that debt is a promise on future work, future energy, and future production. We have essentially pulled forward so much demand from the future that the system itself is starting to buckle under the weight. And for the United States, the country at the center of this global system, the problem is becoming critical. Just look at the interest payments on the national debt. They are exploding. In just 4 years, they've almost doubled, from about $500 billion to nearly $900 billion a year. And the projections are terrifying. They're on track to hit almost $2 trillion a year within a decade. This is what experts call a debt spiral. You reach a point where you have to borrow new money just to pay the interest on the money you've already borrowed. It's the mathematical endgame. There's no way out. And this isn't just a problem for wealthy countries. For literally billions of people, the consequences of this debt trap are here right now, and they are brutal. According to the source, nearly half the world's population, 3.4 billion people, live in countries where their government now spends more money on interest payments to foreign banks than it does on healthcare for its own citizens, more than on education.
Just let that sink in for a second. The debt system is literally draining the resources needed for basic human development and shipping them to creditors. It's creating massive instability.
And now, the geopolitical signs of Stage 3 are becoming impossible to miss. You have the BRICS nations, Brazil, Russia, India, China, and their new partners actively building their own payment systems to get around the dollar. Russia and China are leading a global push for de-dollarization. Even Saudi Arabia, the linchpin of the whole petrodollar system, is now openly talking about selling its oil in other currencies. Meanwhile, central banks are caught in an impossible trap. If they raise interest rates high enough to actually fight inflation, they'll crash the system by triggering a debt crisis. But if they keep printing money to avoid a crash, they'll just create even more inflation. There are no good moves left on the board. This is the textbook definition of a crisis of confidence.
So if we are in Stage 3 and heading towards Stage 4, the next obvious question is, what does the end game actually look like? Well, history gives us a very clear roadmap. As people lose faith in paper money, their capital doesn't just vanish into thin air. It flees. It desperately searches for a safe place to hide, and it always runs to things that are real, things that are finite, and things that a central bank cannot create with a few keystrokes.
And that brings us right back full circle to our original question. Why oil? At a time when everyone is talking about green energy and electric vehicles, why are some of the smartest financial minds on earth making huge bets on this particular tangible asset? The answer has less to do with next quarter's earnings report and everything to do with the fundamental nature of energy itself during a monetary reset.
First, let's just get crystal clear on what a tangible asset is. It's something real, something with a physical form that you can touch. A stock, a bond, your bank account balance, those are all just financial assets. They're digital entries on a ledger, basically IOUs. Their value depends completely on your trust in the system that issued them. But the value of a tangible asset, like an acre of land or a barrel of oil, is intrinsic. It's valuable because of what it is and what it does, not because of a promise from a government. Now, among all the tangible assets you could own, energy is arguably the most essential, the most fundamental of all of them. Why? Because you simply cannot print a barrel of oil. You can't conjure up a cubic foot of natural gas. Energy is the master resource. It's the lifeblood that powers every single other part of our modern world. Without energy, trucks stop running, factories go dark, you can't make fertilizer to grow food, and armies can't project power. A society could function without its currency for a while, but it cannot function for a single day without energy. Its value is absolute.
So when these billionaires buy shares in companies like ExxonMobil or ConocoPhillips, they're not just playing a stock ticker. They are buying a direct claim on real physical production and the enormous tangible cash flows that come from it. I mean, look at these numbers. These aren't speculative tech startups burning through cash. These companies are gushing free cash flow, all of it backed by pulling a physical commodity out of the ground that the entire world needs to survive. They're paying reliable dividends year after year. That's an income stream tied to real economic output, not some clever financial engineering. This is a defensive play to anchor their wealth to something real.
Ultimately, the entire argument boils down to this one inescapable truth. You can bend the laws of finance and economics for a surprisingly long time, but you can never, ever break them. The phrase, "this time is different," is famously called the most expensive sentence in financial history. Every single empire that thought it could just print its way to lasting prosperity has been proven wrong. The math is undefeated. A society simply cannot sustainably borrow and consume more than it actually produces. Period. So, we're left with this final critical question to think about. Is this time really different? Or are we standing on the edge of Stage 4? The reset. The data strongly suggests we are following a historical pattern with chilling precision. The smartest money in the world isn't sticking around to see how it ends. They are moving now. They are converting their paper claims into tangible assets that can survive the storm. They understand that during a monetary reset, wealth is not destroyed. It is simply transferred.
And the question you have to ask yourself is, on which side of that transfer do you plan to be? Thank you for joining us on the Bullion Signal Podcast. If you found this analysis valuable, please share it with someone you think needs to hear it, and be sure to subscribe for more deep dives into the signals that truly matter. Disclaimer: the content in this presentation is for informational and educational purposes only. It is not intended to be and should not be construed as financial, investment, or legal advice. Please conduct your own research and consult with a qualified professional before making any financial decisions. You are solely responsible for your own actions.